welcome to One-to-One Cape Town. We're very happy to be back here in Cape Town for this event, which is always one of the most kind of anticipated events of the year. So thank you everyone for joining, and we hope we have really kind of engaging next couple of days. So just a few housekeeping notes. We have lunch at the far end of the tent, so it's not on the lawn, it's at the far end if you're looking for it. If you want to book in any meetings, the meeting desk is just by the front entrance to the tent over here. So if you see any companies that you want to meet with, just feel free to visit my team at the desk. And cocktails today will start at 5 o'clock on the lawn, so be sure to stick around for that. And without any further ado, I'd like to start with our opening panel. So the mining investment leaders. So I thought we could just do a quick introduction to each of our panelists, let you introduce yourselves, and then we'll get into the questions. So maybe let's start at the far end.
Good morning. Thanks, Amy, for hosting us. My name's James Dendle. I'm the Chief Operating Officer of Triple Flag Precious Metals. We're a streaming and royalty company, precious metals focused, based in Canada. We've made a number of investments in Africa, but specifically South Africa.
Morning. I am Paul Brink. I'm the CEO of Franco Nevada. We're also a streaming and royalty company, principally precious metals. We do also invest in other commodities, oil and gas, and also diversified metals. And our focus is, much of it is in the Americas, but also have quite a bit in Africa, in South Africa, and also in West Africa.
Morning, everybody. My name is Philip Clegg. I'm a managing partner at Orion Resource Partners, now based in Abu Dhabi. We are an $8 billion mining investor specialist. We're private capital. We invest right across the capital structure into mining projects and for M&A capital.
Hi, I'm Julian Treger. I'm the CEO of CoTec, which is a company which is looking at disruptive technologies and then applying them to particularly waste as a new way of inventing the mining company in the 21st century.
Morning, Cathy Nader from Nedbank Corporate and Investment Bank, one of South Africa's big four banks. I'm from the mining and resources team, where we do structured debt finance for the mining sector. We are open for business all the way through from project financing to corporate debt. A lot of focus on the African continent, but also Australia, Canada, and Europe.
Good morning, everyone. My name is Molebogeng Mazibuko. Thanks for having me. I'm from Africa Finance Corporation. We are a multilateral development bank with 44 member countries in Africa. We're headquartered in Nigeria. I'm from the metals and mining team. I work there as an AVP mining lead. To date, we've invested over $1 billion into the mining sector. Like Cathy said, we're also open for business. Thank you.
All right, great. So I thought we could start quite broad, and then we can kind of focus it. But there's quite a bit of stuff happening around the world, and all of geopolitics, economics, all impacting the industry today. So what are the kind of key impacts that you are seeing on the metals and mining industry, and how is that impacting investment flows? So maybe we'll go ahead and kick this off.
I actually thought I was gonna want to be the last person to talk. But what we're seeing in the market, especially from an African perspective, is obviously the geopolitical play. I mean, it's no secret that, in Mali, several licenses have been seized. It's no secret that the cadastres are not very transparent all the time in different jurisdictions in Africa, which can somehow discourage the investment sentiments. It's no secret that, the infrastructure backlog in Africa is significantly high, probably the highest continent with an infrastructure backlog globally. And that is not aiding or enabling investments into any industry, including mining. especially when you talk about your typical bulk metals. I mean, a case study that we all know is the Simandou, which is obviously now becoming a successful story. We all know how long that took. So it's a geopolitical perspective, it's an infrastructure perspective that is somehow inhibiting investments into the sector. But there's also upsides. There's a lot of jurisdictions that are working on polishing up their policies, that are revising policies to be more transparent. I mean, look at Botswana. Botswana has one of the best mining cadastre. It has one of the best database if you want to apply for a license. Everything is just online. If you are number 2 applying for a specific prospecting right, there's a clear communication plan. So we're seeing also a lot of improvements other than just the negatives that are starting to build up the African mining industry because, from a future-proofing of mining perspective, we now need to somehow collaborate in mind and start saying what will make the industry better. There's many vehicles that are trying to connect the region from a policy making, from a planning making in mining. So that same school of thought is starting to shape the industry to sort of be in uniform with each other, where there aren't a lot of nuances that sort of drive away investments. Thank you.
I'm going to keep it open in case, the next, whoever else wants to jump in, feel free.
Thanks, Amy. I think regional geopolitical risks are obviously a key factor when we, look at any opportunities. But the global geopolitical climate at the moment with Trump and obviously China creates opportunities for Africa. Trump is looking to secure supply of critical minerals out of China, and we don't know how that's going to play out, how China will react. So this creates a sort of a geopolitical risk overlay that we're probably going to see come through in price volatility. And for us, that's a key factor we consider when financing any project. And we go back to basics. As long as the capital structure works, strong management, robust cash flows, those overlying themes are not going to stop us doing deals.
Yeah, I think there are 2 interesting trends. One is that change is happening more quickly, but our sector is a long-term sector. So, the Trump tariffs could change in a couple of days, like we saw in Colombia. And certainly over the last year or 2, we've seen what's considered to be critical in terms of minerals change. So I think that's an issue for our sector in terms of long-term planning. And the other issue is that whilst the geopolitical significance of our sector has significantly increased, the connection with the market hasn't been improved. And so there's this tremendous disparity between the perception of the sector, in Washington or in Beijing versus in the markets of London or Toronto. And how that gap gets closed is an issue that needs to be solved.
I'd say that the most pertinent topic for us as a business right now is investment from the Middle East. So we, you may have seen this on Thursday, announced a $1.2 billion JV with ADQ. ADQ is, in my view, the most dynamic of the sovereign wealth funds in the Middle East. And we've done that for a very specific reason. And the reason is to invest in emerging markets. So our traditional LPs are saying to us, we prefer if you invest in developed markets, but actually through this JV, we get to, supercharge what we're doing into emerging markets. And the reason that we wanted to do that is because that's where the opportunity lies. Okay. And so if you couple, additional, dollars to invest in the region, with political capital, which is what, the Abu Dhabi government is giving us, you have that level of comfort to be able to invest more into the region. And so we expect to be making more investment into Africa, into Latin America, into Asia as well.
My take on it is driven by the gold market, and that's principally the market that we invest in, and the overarching trend you've seen in the last couple of years with the world splitting into two trade blocks, the Western world trading block and then the BRIC trading block, really has changed the nature of the gold market. Through much of my career, the conventional logic on the gold price was the bottom was set by the Chinese and the Indian retail buyer, but to have a run on the gold price, it was driven by the US financial investor. And that really has been changed. Those correlations have broken down. And the reason is the marginal buyer of gold the last 2-3 years has been the BRIC central banks, led by China. They peaked at about 1.3 trillion of US dollars in their reserves. They've been selling that off. It's now down below 800 billion. They've been replacing some of that by gold. So China has taken the lead. They've been followed by the other BRIC central banks. It's a major structural change in the gold market. It's a long-term change. As you can see, it's been driving gold prices higher, along with a bunch of other risk factors. But I think it's a major change in our generation, and I think you're going to see gold assets do terrifically well over the next couple of decades.
I think on a macro level, it's chaos, right? There's whipsawing policy that is probably going to continue to whipsaw for the next couple of years. We're dominated by a US presidential cycle that ostensibly is 4 years long, but really is split into 3 months of integration, a year or so of actual governing, midterms, and then the run up to the next US presidential election. And I think what we saw the first Trump administration was very rapid shifts in policy that was largely dictated by Trump wanting to see the markets perform well and as a proxy for his own success. So I think when you stand back, it's problematic and very difficult to see how it resolves itself into the metals business in general. And Paul made the point that if I'd sat here a couple of years ago, I would have strongly believed that there was the concept of friendshoring, where flows of commodities would generally be orientated towards the West or the BRICS. And that, if you were within one sphere or another, you'd benefit from the support of either, those countries that comprise the extended BRICS or the US. Whereas now I think that's probably broken down, because the US is following a somewhat imperialist and almost isolationist set of policies that I don't think are necessarily lending themselves to this idea of friendship or within the sphere of the US umbrella. So I don't think the trends hold as well as I might have expected. So I don't know how that plays out. But Cathy made the point on the projects. And I think whilst the macro level is really complicated, at the project level, we're still all looking for the same things as we've always looked for, which is good, well-run projects with a prudent and appropriate capital stack that we can finance and develop. And you can understand the individual risk outlook for a given country probably better than you can the whole risk overlay and how it translates. So I think good projects will still shine through despite a really chaotic macro setting.
All right, so just a reminder to the audience, we are going to open up for questions from you guys. I do have a good set of questions here, but we also want to hear what your questions are for our panelists. So if you do have a question at any point, please just put your hand up and we'll get a microphone over to you. But looking regionally, looking across Africa, can we talk a little bit about how some of these broader themes are impacting or creating new risks or new opportunities for the industry across Africa? So we've talked about the Middle East being kind of a new major player investing into African markets. We've talked about kind of future-proofing, and the role of the critical minerals within the region itself. So, what are these kind of emerging opportunities and the risks that you're seeing these days? Cathy, do you want to?
Thanks, Amy. So, as I said, the US and the other powerhouses are looking to secure critical minerals. That's a great opportunity for the continent. There's so much in the ground in Africa That being said, as everyone is focusing on ESG and sustainability, it's important for the African governments and regulatory authorities to practice the ESG themselves. They need to display environmental stewardship themselves, not just the mining companies, in country as well. Social skill upliftment, community development, and of course governance. So while there's a big opportunity for Africa, the risk is they need to attract investors and they need to make sure they comply with ESG requirements themselves, as well as the mining companies need to do that.
Can you talk maybe a little bit about, the investment coming into the region? Is it there? Is it to the extent that is needed to kind of?
It's definitely there, but I think more is needed, and Molebogeng can talk to that. We, as foreign investors into Africa, we have certain criteria. There is resource nationalization, security risks that are also overshadowing the potential in Africa.
So let me play devil's advocate. And my views, right? I always say, let's separate maybe sometimes the individual from the company. My views is that there is a lot of capital coming into Africa. And that's been the trend for decades and decades. We've seen a lot of capital from China. We've seen a lot of capital from Europe, from US. Now the new kid on the block, UAE, wanting to bring a lot of capital in, which is an upside, right? So for me is when they do bring capital into Africa, what is our bargaining position? Because we often talk about value addition, let's beneficiate closer to where the mine, closer to the source. But often these ambitions are not met because maybe we're not bargaining when we get the capital, because whoever gives you the capital, chances are they've set house in their own country to process. So the element of future-proofing here then becomes when we are taking money because we are heavily endowed in Africa, what are we supposed to start saying to say, how do we share the benefits from processing? If I'm going to do midstream, at least in Africa, you can then do downstream in your country. We need to start ensuring that we are multiplying the revenue that we're making just from an upstream play, because we're probably using a 4-fold or 10-fold. I mean, yesterday I was at CTICC and one of the processing companies, a new processing company in SA, was saying, just by playing a downstream role, our revenue from a mining upstream play is 10-fold. So I'm thinking, devil's advocate, our bargaining needs to change. We are no longer desperate for capital because we also have something we're putting on the table. So our attitude towards capital must change. However, I'll go back to the fact that it is a huge upside that Africa is being looked at as an investment destination. And I agree with Cathy, there is sufficient capital out there. One thing that we also never think about, there's also sufficient capital domestically that we can now start investing into projects. I just don't know where it gets allocated. Thanks.
Anyone else want to jump in?
I suppose one thing that we see a lot of, and Paul may be able to comment as well, we speak to a lot of North American investors into Triple Flag, and I'm sure Paul speaks to very similar investors into his company. And one of the challenges we see a lot is investors in the US and Canada in particular look at Africa as a monolithic block, and they make very few regional or local scale distinctions. And one of the things we're often talking about is, we invested in Ivory Coast last year. We continue to look at investments in Africa along with two that we have done in South Africa. And we're often trying to explain, okay, there are certain countries which from our point of view are investable and certain that aren't. What are the differences between those countries? So I think there's an educational element to help outside capital understand how people allocate capital to the continent and what the risks and opportunities are, because there is a wonderful opportunity set more broadly across this continent. So linked to that is the timescales over which we invest. So in the streaming and royalty business, we're very often exposed to these operations for extremely long periods of time, basically for the life of mine. And we offer a long tenor form of capital that gets paid back over many, many years. So we may be in a country through 1, 2, or even 3 election cycles before we've had our money paid back. So the capital's at risk for a very long period of time. So finding countries that can offer a period of consistency of government frameworks and allow operations to be successful over that period of time is crucial. So that's what we're looking for, and frankly, part of what we have to explain to our investors when we make investments that are outside the typical mining jurisdictions.
I agree with Jim completely. The key point here when it comes to investing in emerging markets and in Africa is stability. You have to have stability. You have to believe, like you say, that you'll be there for a few election cycles. And so trying to square that circle to attract investment is the key thing that has to happen. I agree that processing, would be a wonderful thing to take place in Africa. I would say that it's risky. It's risky to do that anywhere, let alone Africa. And one of the things that we have to attract globally to our business is actually human capital, right? We don't really understand how to do that kind of thing. That's the kind of thing that's done in China. So those are the two challenges for me in terms of investing on the continent: human capital and stability.
I mean, I think the human capital is probably a positive for this continent. I think I'm quite convinced that if you go to a high school in North America or Europe, and I've seen the data for the UK, people are not choosing to work in the mining business. And it's a huge shame to me personally. And when you look at the provision of skills for the sector, I think you're 100% right. It's hard enough to find skills for equipment operating, very traditional sort of mining skills. When you're looking at downstream metallurgical operations in particular, it brings or requires a very complex and quite niche set of skills that's not massively prevalent in the sector at large. But I think one thing this continent has is a young population with a huge amount of potential. So if that can be tapped into, there's a lot of potential, but that has a much broader set of questions around government's ability to provide education and basically, see that demographic develop.
Maybe one additional point for myself is in Africa, right? The key advantage as well is that you have a financial system, or rather investors that have an appetite for Africa. I'll give you an example. FC, we invested in Guinea, in Gabon, in DRC, Sierra Leone, even on the southern side of Africa. We've invested in places where when we're investing, no one wanted to go in. Some projects that we've looked at from a risk profiling perspective, I'm thinking about the Nyanza titanium oxide project in South Africa, where no one wanted to go initially, where we took the risk, and now everyone at least has come on board or they're coming on board to support. I'm thinking about FG Gold, where we went in at project development, where in a spot where people did not want to go in, and suddenly people are starting to come in. So we have investors that are able to take that initial risk, and that is a significant booster to, I guess, watering down the appetite and ensuring that other players can start to see value. So it's not like we're in this corner all alone and there's no one looking at us internally. There are internal players, Nedbank, there's commercial banks, there's DFIs, your IDCs, that want to be in it and they're not trying to exit it. So that's a key booster for the industry.
And so how are the local investors and other industry players such as Nedbank kind of helping to propel the industry forward and to kind of share what they do to kind of bring in a broader audience?
I think you're starting to see a lot of plays where we're syndicating or we co-investing. And as we co-invest, I think there's an elevation of the narrative about Africa investments. Because whenever there's a success story, all of us start to tell what the success is. So it brings an elevated pitch to the rest of the world to say, these are good projects. So yes, there are external factors maybe close by, but when you have a strong management team or a strong sponsor, people tend to be solution-driven and are able to make a success out of a project. So those are some of the key things that we look at to say, how strong is the partner? Cash flows-wise, how strong are the cash flows? But I think more importantly, it's your partnership with the management team and the sponsor. Thank you.
Absolutely. And, Nedbank is often the only African bank in a lending syndicate in some of the transactions we do. And having an African partner in a lending syndicate, does bring comfort to the other lenders. We're very like-minded. We have similar goals and very aligned on how we do deals, but also for the company itself. Having an African bank that can support the company in country with other products, export LCs, on the ground banking, does help the company in their financing structure.
All right, so, we've got a question just at the end, and then we'll continue on.
Hi. Yeah, I'd like to throw in 2 or 3 questions, really, but all related. I mean, none of the comments so far have really discussed Trump and his new tariff regimes. And I guess in particular, as far as South Africa is concerned, the threat of 100% tariffs on BRICS, which is something the BRICS group just haven't got their heads around yet. But I mean, that would put South Africa in quite a negative position vis, Namibia, for example, if that actually happens. That's the first question. Secondly, on critical minerals, anyway, I think the US is beginning to put a bit of a tariff wall around the United States, trying to get preferential investment into the United States. Thirdly, in terms of downstream processing, you talk about Africa, but I think Africa is very country specific in the sense that I don't think Zambia or Zimbabwe, for example, would give any benefit to a project where all the processing was going to be done in South Africa. I mean, they're looking for investment in their country. They're not looking to benefit the African continent. So I think it's possibly misleading to talk about Africa as a whole, unless you're going to tell me there is some mechanism for SADC investment or something, which perhaps there should be, but I don't think there is at the moment. So those are my 3 sort of related questions.
Maybe we can go.
Maybe I can start off, and it got me thinking. There's a book which really helped educate me on the battery metals. It's called Volt Rush. If you haven't read it, it's really worth reading. I started with the conception that global warming was a global issue, and the world would work in concert to try and address it. And reading through it, it became very clear to me how so many countries think about it is just their own competitive abilities. And China took the lead on EVs 15, 20 years ago, and it looks to be the global leader. The other parts of the world, rather than seizing on, we've got to address the issue of CO2, look at it from the perspective that the auto industry is such a massive industry for so many regions, for Europe, for North America, that their response to it is less about global warming. It's more about how do we protect those industries. And so the response it's very nationalistic. And I think what we see is happening, as you say, for Trump, but I think for other regions, people saying, how do we protect our own industrial base? How do we secure the minerals or all the supplies coming into that? I think the implication for that is the world will continue to break up into these various trading blocks. One of the things we think about, James made the point, when we're investing, it's not for 3 or 5 years, it's for 20 or 30 years. And so a big question we got to ask ourselves is, where do we think that country ends up in 20 years' time? What trade block is it going to be in?
Just on that, on the what trade block, I mean, South Africa, I think you're within the SADC, but equally you're within BRICS, and if BRICS is specifically sanctioned because of the anti-dollar stance of BRICS, which geopolitically, I think Putin and Xi have worked on that, and it's quite a rational position, but it's one which it's sort of rational for Trump to attack as well. It's going to put South Africa in quite a difficult position because it's in between two different trading blocks, and BRICS could be specifically sanctioned.
Yeah, no, I see it as a short-term risk for South Africa. If you ask me, where do I think South Africa ends up in 10 or 20 years' time? It's in the BRICS.
I think it's interesting, though, because Trump has a very clear ideological perspective on how it should work. He has a distinct view of US versus pretty much everyone else. And I think it's either, literally part of the US as opposed to just being friends with the US, or you're not. But I think what hasn't been demonstrated or is not appreciated is that there's a flow of physical commodities that's required. So the tariffs are appealing for lots of different reasons, particularly rhetorical ones. But over time, there may be a demonstration that, well, actually, tariffs are causing the flow of commodities to go elsewhere. And I think it might cause a re-examination of how the US approaches the provision of commodities for exactly the reasons you mentioned. They physically need those commodities to come in.
There's quite a lot of projects in the United States which could see the light of day, but have been blocked by environmentalists so far. And so if they weaken the environmental legislation, they could do quite a lot more production in the US.
They could, but I think the lead times are still, relatively long. But I think you're exactly right. We saw it last time round, 2016 to 2020. There was I think globally a move towards more right populist governments, which generally expedient from a mining permitting perspective. That didn't translate to a lot of additional production in the US last time around. Perhaps it does this time. We were talking this morning about this maybe being part of a 10-year view of recasting how the US looks at things, so beyond the Trump presidency. And I think that time horizon is more compatible with adding US production. But some of those projects are so deeply contested. I mean, Pebble, I was talking to a colleague of ours who's been in the US mining industry for 35 years. He thinks the Pebble project will never get developed. It's his personal perspective. Regardless of the administration, resolution has been a contested project for a long time. So I think a number of these projects become political footballs and get stuck. So whether it can be addressed in a 4-year period, I'm dubious, but if they change the footing and perspective of the permitting regime in the US, I think over the next 10 years, it could provide for excess capacity that may limit the extent to which the US really relies on overseas production. I mean, you look at the fracking business, it completely changed the US relationship with the oil as a commodity.
Philip, when I was talking earlier about the rate of change, I think the culture of the Trump administration is going to be to test things and then change them if they work or don't work, but quite quickly, which makes it very difficult to plan long term. But I would expect them to put some tariffs on South Africa, because South Africa has really misbehaved over the past period of time. They've been very closely allied with Iran, not to mention Russia and particularly under Zuma, but now China under Cyril. And so I would expect them to get around to applying some pressure on South Africa in due course. When I talked earlier also about critical minerals, I think the definition of critical minerals is changing, and it's becoming much more defense-led than necessarily electric battery-led, because the Chinese have clearly overproduced vast amounts of the materials for electric batteries. And in any event, it looks like in the very long term, those batteries are going to be just sodium batteries in large part. So I think, it's those materials like tantalum and tungsten and critical rare earths that are going to be more of the focus when we talk about critical minerals going forward.
How are kind of the Trump policies and other kind of global policies that are coming out kind of going to impact the supply chains and the metals value chains overall? what are the kind of the broader impacts that you're seeing for the global markets?
Well, I mean, I think there's going to be differential pricing in the US, outside the US. There's going to be different supply chains. And short term, as we go from a global just-in-time system to many different national supply chains, that's much less efficient. So there'll be more stockpiling, which we've been seeing a bit of. But ultimately, the world will pay a price because it's going to be less efficient.
I'd say short term there is certainly uncertainty, but we operate in Washington at pretty much the highest level to really understand what the US wants to achieve when it comes to critical materials, and we've been doing that now for a few years. And I'd actually say that it's pretty much a bipartisan policy that security of critical materials needs to be had by the US, and we're seeing a keen interest actually from the US government in terms of trying to achieve that, and so we're working with them closely in that regard.
But don't you think there's a shift between interpreting a secure supply as meaning from your allies to just domestic production? I think it was Julian, I think, probably just said, Trump sees things that either you're in America or you're outside, and that's a shift, surely.
Yeah, I think Julian's point is a very good point in terms of, my thinking in terms of where you have at least some certainty on Trump is around the military applications as opposed to the EV applications. We have a project that we got an interest in Idaho. It's a rare deposit. It's a combination of gold and antimony. Antimony used in munitions, particularly for heavy artillery shells. That project was stuck in permitting for the longest time, but actually got pushed through by the Department of Defense in the back end of last year. So really driven by that military thing. On Trump, the one thing about him is for sure, it's around nearshoring, strengthening the U.S. industry, bringing industry back into the country. The piece I don't know yet is where that falls out between fossil fuels and EVs. It's a hugely strong lobby. One of the things that struck me on a trip to China last year was just the difference in motivation between China and North America. China is the world's biggest oil and gas importer. North America, the US and Canada are huge oil and gas producers. So for each of those, China really is incentive to get onto EVs. North America, politically, there's a huge resistance. The oil and gas industry is very strong and a huge lobby group. So I don't know where Trump ends up. I don't know if he ends up in the camp. One of the things he said is just drill, baby, drill, which is drive the energy industry. And perhaps that need for critical minerals supporting an EV transition is given less focus. But he's made other comments, and this is why I say don't know, where he said, he's going to focus on critical minerals. So I think that part of it, we still have to see where he finally settles.
I strongly suspect there'll be disappointment over the rate by which domestic projects and companies can bring capacity online, though. I think that's going to be a gap in the policy versus reality that they'll face at some point.
We do have another question over here, if we can bring the microphone over. Also, there's quite a few chairs right in front, so if anyone standing wants to come take a seat, you're welcome to come down.
Thank you. Liam Treger from Argonaut, and fabulous panel. Really enjoying the comments. Just moving the discussion along, I guess cryptocurrency from the gold space, I think we've always thought it was a bit of a joke, but Trump has legitimized it now. Do you see that as being a realistic alternative asset class and potentially a threat for some gold investment getting diverted into crypto? And the other one quickly, any comments on artificial intelligence? We're seeing it in the mining sector, people using machine learning for drilling. But I'm just wondering whether you guys have embraced it in any form for your business. Thank you.
Well, Liam, I'll jump in on gold and crypto. I'll leave the second part to somebody else. I don't think there's a big overlap between the two. Gold is fundamentally a risk-off investment. Crypto is a risk-on investment. All the correlations with crypto, the greatest correlation actually is with the performance of the NASDAQ. When the NASDAQ is up, crypto is up big. When it's down, it's down as well. So while there is, in terms of the thesis, the hedge against fiat currencies, that there's a tiny bit of overlap. I think in reality, it's two different buckets. So I don't think crypto impacts the demand for gold bullion. Where it does impact the industry is the demand for risk assets. It's a risk-on investment. Mining exploration is a risk-on investment. I think where crypto steals from the industry is stealing dollars from risk-on mining exploration.
I'll take the second question, actually, but I agree with you. So we actually started a venture capital business last year, which is now made of sort of 5 or 6 investments, and it's all because of what you just mentioned. We've been something of a laggard, over the years as an industry, just overall. And there are huge opportunities to create efficiencies within the value chain of any mining asset. But we see that particularly in mine planning, not so much in drilling actually, but mine planning and in processing. And so, I agree with you, it's a huge opportunity.
Absolutely. We've been thinking a lot about artificial intelligence, and it can improve processing, data analytics, safety. I think what's interesting for us and what we need to get our heads around as funders is how the AI used in exploration is going to feed into a BFS and how we take reliance on that. And that's something that's, a focus of ours at Nedbank.
For a number of years, I was on the board of a company that was doing really cutting edge research in deploying AI applications in the exploration space. And they did some excellent work and actually through that discovered a major gold deposit in Canada, which is currently being developed in Newfoundland. So the technology was fundamental to that discovery, and the research that was being done was incredible. I mean, it was really impressive by some wonderful geoscientists. The challenge they faced, though, was turning the science into a business. It's a very R&D hungry business, but the addressable audience for the technology is relatively small. Mining exploration is a small and relatively undercapitalized sector of the economy. So it's very difficult for them to take the projects they were running and the products they were developing to the next step and basically not run it as a consulting business. So I think, Philip's talking about funding these ventures, I think is actually really crucial that capital is being deployed in that cutting edge research, because it's so difficult to make headway. And very often a number of the clients that these people had are those that are the least able to pay their bills. So they're trying to find other ways to monetize their technology. So it's very difficult, but it's, one thing we do in exploration in particular is generate huge amounts of data, but very little information. And what they were really seeking to do was get more information from our data. We generate lots of it, and it sits in core sheds in Northern Ontario or on servers all over the place. So there's a huge opportunity there that I think is extremely underutilized, even with some of the advances in the last couple of years.
So you go ahead.
Okay, thank you. Just to add on to this discussion, I think for me the challenge that I see, and is also an opportunity, is how you then transition the AI applications into the reporting instruments that we use for mining. How JARC will then account and verify that this data is something that is acceptable to the industry from a global standard perspective. So that will be interesting to see that particular transition. I'm even wondering if there's already a think tank focused on this particular aspect, bringing the AI in, or if it's just still us dilly-dallying and still talking about it. It would be great from these kind of discussions to then say, how do we then develop a global think tank that can now focus on pulling it into practice? However, I wanted to answer the gentleman's question earlier about the fragmented Africa. I tend to be more interested in Africa than just talking about Trump. Sorry, Trump. So yes, it's a fact. Africa is extremely fragmented. But there's been several think tanks around how to bridge the gaps. For a good example is the potential precursor plant that, there's some parties that have invested in a research report, including AFC or Afrexim Bank, to say how can we then put a precursor plant between Zambia and DRC because there's a lot of feed. The other one is the titanium project I was talking about earlier, which is procuring their feed from Mozambique. So you're starting to see a lot of play within Africa where I'm buying feed from this neighboring country to process in my country and not necessarily taking it to China. However, the dynamic about China is the fact that sometimes it's easier and cheaper to export to China than to export to a neighboring country. So there are still several, bodies that are trying to see how do we reduce the cost of transporting material in continent. And that's something else that we need to, be on the lookout for, because once we can win with the cost aspect of transporting in continent, I think there's going to be several plays in terms of increasing the processing capacity in continent. Thank you.
So just returning to my earlier theme, AI is a weapon. It's clearly being weaponized, and there's an economic and military battle between the East and the West. So what's interesting from my perspective about AI is what it's going to mean in terms of demand for our industry. We clearly are going to see a lot of demand for uranium in terms of the power, and that's a theme that's well established. And then, one of my businesses is recycling magnets in the US, because the magnets are going to be needed for all the hard disk drives. And if they don't get them in the US and China stops them, then the US progress on AI will be much more limited. So I think you can think about AI's application to our sector in many different ways.
Yeah, I'd just echo what Julian has said there. Your mind goes to what are the opportunities that AI creates, and it's, I often think, way back then when we started with our phone and you could send emails and texts and the amount of data we used, and then to think today where just about everything that we get is graphical, and the quantum leap in the amount of data that gets transferred day to day just because of that. And to me, AI is just another quantum leap in the availability to us of data, and I think the world being, who we are, everyone will seize and want to get the ability of AI, but that means the amount of data that we're all going to use is going to multiply by a quantum of 10, and so that goes to where's the energy going to come from to generate all of that. In the US, there's a huge land grab going on right now for people saying, where can we build data centers? Where is there sufficient power? How do we put in sufficient power that we can power up these data centers? That trend is going to spread around the world as people say, how do we participate in this? How can we have that data generating capacity? I think that's going to be a huge opportunity for investment.
We will be having a panel tomorrow, a uranium-focused panel that's definitely going to be touching on this, so come back into the panel room for that. We have one more question, and then we'll start to wrap it up.
Hi everyone, it's Heather from AB Global Mining. I have, we touched on the Chinese influence in the markets. For instance, the DRC has just recently come out and said they're 80% owned by the Chinese, all their operations and minerals and so on, but they want to divest and bring in the rest of the world. Two questions. How do we grow the investment in the countries dominated by the Chinese? And yes, we can do that one. And is the government open for companies to come in?
I would comment on that one. So you see this in certain countries. You mentioned the DRC, but I would actually point out Indonesia. I think that's probably the most pertinent country, which is, let's be honest, been completely dominated by China, particularly in the nickel market. but we are aware that there's a new president in Indonesia right now, and it is not a comfortable position for that country right now to have that level of dominance from the Chinese. And so there is outreach to try and attract Western investment into the country, something that we're working on quite closely. But the question is, how do you do it? Because you need operating partners. And who are the operating partners? It's very, very difficult.
On that note, so there are a lot of competing priorities where a country needs capital and they get external capital because the party that comes in often have their own priorities and objectives. In a case like that, I really don't see a balance. The only balance that I foresee is with new assets. I mean, if you go to DRC, there's a lot of projects being explored. Not all of them are China-dominated. There is obviously a Chinese play, which we are grateful for because it's enabling the advancement of the industry. But there's still an opportunity for other parties to come in. The question now is, are there other parties with appetite to come in? Is there sufficient capital that is looking for the same opportunities that the Chinese are looking for? I mean, the dynamic in DRC is the fact that they have a lot of cobalt, but they can't process it because of other political things that are attached to the cobalt, whether it's child labor or whatever that the whole global world is assuming about the cobalt. Hence, they're not always buying directly from DRC. But when China is selling, they buy from China, not understanding or asking themselves questions that it is coming from DRC. So there's certain advantages to having the Chinese capital there that has enabled the DRC economy to also achieve certain milestones. So I really don't see the balance because there's competing priorities. Unless we say, let's go in alone and invest in this project alone without the Chinese, often there's not enough capital to cover the total project cost. Thank you.
And I think, you've got to ask why the Chinese were there and not other investors. And if those fundamental risks or situations are still there, it may be difficult to get in other investors, but it's always going to be a stable regulatory environment. No sanctions, it depends on the context of the country, a good project, good asset, all the basic fundamentals still need to be there, and then the investment should come.
I think one of the challenges is these, if you think about it from the point of view of a Western company as an alternative to a Chinese company, you have to ask yourself whether they have a mandate to take on the risk that is inherent in some of these jurisdictions. So if you're, sitting opposite shareholders and you're a major diversified mining company, do you have the capacity to tolerate the headline risk, the instability that may come from investing in the DRC? So I think there's a lack of risk appetite, which probably reflects the appetite of the shareholders of many of these companies to tolerate that sort of risk. And I don't think it's there. I contrast that to a group like Zijin, who have been on the most incredible acquisition track record over a number of years and have generated huge value for their shareholders by acquiring interest in projects, including in the DRC. They clearly had a mandate and have a mandate to continue that growth. They've, with the next company that's up, I see they've made an investment there recently as well. So I think it comes back to the mandate these companies have, and Western companies in many instances do not have that mandate. And I think what changes it is, demonstrated stability over a period of time, which is very, very hard to achieve.
Can I just add one point? I'd like to revert to my initial point. So you need local investors that have an appetite for Africa, because instability and uncertainties can be unpredictable. So you need people that understand that either way, we just invested in DRC, in Kamoa, that know that you can't always predict it, but you can at least try your best to mitigate the risk where you can. But you need investors that have an appetite, an unbiased appetite for Africa. It's Africa or nothing. And I think AFC is really one of those investors. Thank you.
All right, so we only have about 4 or 5 minutes left. So I thought we could just kind of get some closing comments from our panelists, just thoughts. We've got a variety of both corporates and investors in the audience today. So maybe some key takeaways that they should take into their meetings and into the networking and, everything else that's happening this week. So key takeaways, thoughts for the industry moving forward. Maybe we can start at the far end.
Yeah, sure. I'll keep it brief. We see huge amount of potential to invest on the continent. We are actively looking at transactions in Africa, all over Africa. We have pretty specific perspectives on what we need for investments, but Triple Flag is actively investing in Africa, and I hope that continues for a long period of time.
I'll pick up maybe some of the comments you made and the discussion we're having in terms of different jurisdictions. What we found over time is when governments have a preference for one party or one country to invest and start giving preferential treatment, often that's a reflection of the government and not of the country. And quite often what you have is when you have a change in regime 4 years later, more likely than not, the new government that comes in will favor a different party. In our business, which is very long term, as we chatted about, we're very wary when a government says, I got a preference one way or the other, because you got to think, what happens one step down the line or two steps down the line. And so we'll echo all of James's comments to say, where we're looking to invest, it is for stable governments where there is a good rule of law, where they treat all the capital equally over time. It's what gives you the greatest certainty over the long term. In our business, we've invested quite a bit in West Africa in the past, quite a bit in Southern Africa. At the back end of last year, we invested $500 million in Sibanye-Stillwater's PGM operations in South Africa. And it is intentional. We really think the outlook for South Africa is on the uptrend. I think it's been a good jurisdiction. Think, Southern Africa in particular at the moment, amongst Africa, Namibia, Botswana, South Africa, have all had very stable and consistent mineral policy. So we like the destination and hope that we can invest more in here in the future.
Just rather briefly, we've always invested in Africa. It's always been a destination for us. I would say, though, over the years, it's become clear that this is a really interesting continent. Some of the assets are really, really excellent. What we would call for is stability. But this is the whole reason why we've just closed this joint venture with the Abu Dhabi government, is to allow us to invest more in this region. Because it provides us with the political cover that we require.
Yeah, I think when we sit here next year, we'll have seen a year of enormous change, both in terms of commodity pricing and priorities. And I think it's going to be important to be very flexible in the months ahead, and that change will create opportunities.
It's very exciting times for the continent. Obviously, key themes, we need regulatory stability, ESG awareness, skills. But I think what's important, and Molebogeng said, we need to be unbiased and not just read a report on a computer and take a view. It's important for equity and debt investors to be on the ground and understand the context in which they're investing.
My very consistent tagline is this: Africa is the opportunity. I don't see any other continent that has such great potential as Africa. Yes, from an upstream perspective, but also from a midstream and downstream perspective. All the countries talk about global north, the global south. They have their politics. Every president that comes in, Biden had his own circle. Trump is going to have his own circle. Presidents in Africa do that all the time. The only difference is the global north, they have their own capital. We need to start generating our own capital. We need, like you said, investors that are fully focused and fully intending to commit to investing in Africa and are seeing a long-term perspective, not a short-term perspective, because, like I said, Africa is the opportunity. Thanks.
All right. Well, that's a great place for us to close off. So I want to thank all of our panelists for joining us to kick off the one-to-one Cape Town today. So thank you.